going on with the mortgage market right now? It just seems like complete chaos out there. Lenders have been pulling products. Some of them have come back with products that are almost twice the price of what they were originally. In this video, I want to break down what's going on, what it is that you should be doing. Hey, if you're watching my videos for the first time, my name is Saj Hussain, and on this channel I share with you my 15 plus years of property investing experience to ultimately help you get further faster in your own property investing business. So a few weeks ago, Liz Truss became the new Prime Minister of the country. Then shortly after that, we had the Bank of England increase their interest rates by quite a significant amount that they hadn't done for a very long time. That in itself was a bit of a shock. Then shortly after that, we had the new mini budget, which was the government's plan in terms of how they're going to get us out of this mess that the country's in right now. The answer to that was massive tax reductions to stimulate the country and the economy. However, many of the money markets around the world were concerned that actually this may not be the best idea right now because there was maybe an inability to repay the massive debt that the government was going to get the country into in order to finance these tax cuts. This then resulted in a massive fall in value of the pound against the dollar. This then resulted in mortgage lenders, i.e. mortgage providers, pulling products from the market because they're unsure where to price them. They already had a massive increase in the number of applications they were facing because the increase in interest rates that were happening and people were rushing to try and fix their mortgages in case there were further rises. This wasn't helped by the Bank of England stating that it would increase interest rates to wherever it needed to get inflation under control. So mortgage lenders were inundated by applications from people looking to protect themselves from further rises in the market. We had a record number of mortgage products being withdrawn from the market in a single day. This wasn't that they were panicking and wanted to get out of the market. Effectively, they were unsure how to price the product because where the market was going. Some lenders have now started coming back to the market, but with products that are significantly more expensive than they were before. In some cases, they're almost double what the rates were just a few months ago. The government has tried to dampen the situation by replacing the Chancellor with a new Chancellor and starting to do some U-turns and backtracks, and really I don't know what's going on right now with what they're doing. Although this has brought a little bit of calm to the market, there's still a lot of jitters in terms of what's happening, and again we're going to be having another budget in just a few weeks time. So if you're applying for a new mortgage right now, the good news is that the time frames are starting to ease up a little bit. Some of the backlog is starting to get cleared. In fact, I got an email yesterday that it's now down to a few days with one particular lender that the broker was looking at, whereas previously it was several weeks before they got even a reply to response to information that they'd sent in. However, the not so good news is the current rates you'd be looking at for a limited company are probably between 6 and 7% for a mortgage within a limited company. And only a few months ago, that rate would have been maybe 3.5 or 4%. So rates have increased by about 3% in many cases. However, there's still concerns with the current Bank of England base rate being 2.25%, that actually next year, middle of next year, it could be closer to 6%. That's a significant rise still yet to occur. These rate changes have already begun to really hurt for some people. Just at the weekend, I was speaking to somebody who has a mortgage that's £200,000. It's an interest-only mortgage, and they're on a fixed rate of 2%, which a year ago would not be nothing unusual about that. It's a fairly common rate. He's coming to the end of that fixed rate period, so he's been looking at trying to get that mortgage now remortgaged and replaced, and the rates he's looking at now is about 6%. So previously, on his interest-only mortgage, he was paying about £330 a month, but the new mortgage will come in at about £1,000 a month. That's a massive increase from £330 to £1,000. But here's the thing, his rent is less than £1,200 a month, so he's barely making any money. But actually, when you take all the other costs into consideration, managing the property and maintenance, etc., he's probably going to be losing money. But here's the biggest challenge. When he comes to remortgage, even if he decided to accept that offer of the mortgage at 6%, what he'll find is that the lender will refuse to provide the mortgage because it won't fit the stress test. And what that means is there needs to be a buffer above what the interest rate monthly payment is to what the market, what the rent is that's being collected. So there needs to be an additional buffer there. And that 200-ish pounds, whatever it is right now on the new product, will just not be adequate. So that means he'll not be able to raise the money that he needs. But he's not going to be alone in this situation. There's going to be many people facing this similar problem. So what's going to be the alternative? Well, some people are just going to decide, well, actually, maybe this is just too much, and maybe I need to now get out of the market. This is not viable. You've been hurt financially in terms of the cost of the product, but also possibly still challenges around taxation as well. If you've got properties in your personal name, you'll still be earning significantly less now than you were previously. So what is it that you should be doing right now? Well, firstly, I can't give financial advice because I'm not a financial advisor, but I can give you my thoughts in terms of what's going on right now. One of the first things to do is to run a stress test on your portfolio. That's looking at your current property portfolio, whether that's 1, 2, 3, however number of properties that you have, what mortgages you have on them, what rates you're paying on them, when those rates will come to an end and what they might revert to. And then test if the rates were increased by 2%, 3%, 4%, at what point would it become exceptionally painful for you to absorb? So you want to be able to work out what that buffer is. Essentially what you're doing, testing the elasticity of your current borrowing to see how far that can go before you start feeling pain. And one of the reasons that mortgage products are so high right now is because lenders in a little bit of a limbo as well. They're not really quite sure how to price products. They're not quite sure what's going to happen. So hence some of the rates are quite high. So it's worth looking at your current rates, your standard variable rates that it might be on. This is after the discounted period is over, they go on to a standard variable rate. Look at what that current variable rate is right now. And it may be that the rate is quite low and that you stay on that and you don't move. And because lenders are a little bit uncertain what's happening in the market, it may be that things settle down and rates calm down. And when they do, at that point, if you need to, you can remortgage then. The benefit being at that point, there shouldn't be any early repayment charges, any exits to come out of that product then, because you're on a standard variable rate, and then you can switch to a mortgage whenever, as and when you're ready, as opposed to being forced to do it once your fixed rate has come to an end. Remember, there's no need to change. It's that people generally tend to change because they want to move on to a lower rate, but you'll incur costs by doing that as well. The other thing to be doing right now is looking at the green credentials of your portfolio. That's what's the current EPC rating. Those that are on an A, B or C will probably find that they're getting better rates from the lenders in the marketplace right now. They're being more favorable to those because lenders are concerned for those that are below a C. If the things change in 2025 as being predicted at the moment, then those properties will no longer be able to rent to tenants without having some improvement work done on them first. So it may be you can review your current portfolio if you need some minor tweaks and changes and improvements to get them into the category or at least a C. And if you're doing a purchase, then I'd suggest working with an independent whole of market mortgage broker, somebody that can scan the market, that's independent and can look at the products, and also somebody that's quite active in the market because they can tell you what lenders to work with right now, because they can tell you which lenders are turning around products quite quickly. Because it's one thing having a lender that's got a great product, but actually it's very difficult to either get that product or very slow trying to get it done. Again, it may be worth considering a standard variable rate product, i.e. one that goes straight onto a variable, that's not fixed in any way, that's not locked into anything, so that you can come out of it quite quickly. You might pay a little bit more for that right now, and if you want to come off that, you'll find a little to no cost in terms of remortgaging to another provider. But remember, none of us know exactly what's going to happen in the coming months and years, and rates could still increase in the coming months, so the new products could still be priced even higher than what they are now, which is what the panic many people are going through, which is why they're rushing to fix their mortgage products now for the longer term. But if you're fixing at a high rate right now and the rates come down, you've really got to make that decision. Are you open to taking that risk? And what's your confidence level and what's going to happen to the rates? Do you think they'll go up more, or do you think they might start to ease? Look, here's the thing, the days of cheap money are now literally over. Some people in their 20s, they've probably never known anything any different than what there is that they're seeing right now, i.e. these very, very low rates. When I started in property about 15 years ago, we used to do a lot of calculations on like 6-7% as a typical mortgage figure, and we're already back at those rates right now. But one thing is for sure, this is going to push some people over the edge. There's going to be homeowners that are going to no longer be able to afford the properties because the way the rates are going, and there'll be investors and landlords that own property that want to exit because it's just no longer profitable for them to stay in that business. But this will present a massive opportunity for those that understand how they can repurpose those properties and use new strategies. If you're going to take a property from a landlord that's struggling to make it work as a buy-to-let, and you're going to purchase it and run it as a buy-to-let, then you haven't resolved the problem. You've just inherited that problem. You have to come up with a solution or something that's going to be different. Hey, look, if you enjoyed this video, then make sure you click on my face over here to subscribe to the channel, but then go and watch this video over here where I talk about finding the right strategy for you to use to get the best success.